Hey, what's going on, guys? Hope you guys are doing well. Today, we're talking about how to survive a bear market or any big drawdown. And it could be a big bull market drawdown as well, right? Earlier in the year, we saw a pretty big drawdown on different altcoins like Ethereum and these smaller cap altcoins. So it's important to have a plan in place to be able to take advantage of the drawdown or to at least survive it, right? If you're new here, my name is Richard. I'm a yield farmer and DeFi investor. I've been yield farming for quite a while now. And if you've been following me for a while, you know that I talk a lot about wide range liquidity pools. The reason why is sometimes the price swings could be quite aggressive, right? Like what we're seeing right now, Ethereum is trading at around $3,200 as I'm filming this. And a lot of people are yield farming with, for example, like a $1,000 wide range. And that simply is just not wide enough to stay in range for a long time to earn a sustainable yield. So that's why I prefer wider ranges. And today we're going to be going over different strategies I've used to survive a bear market. And I've been in a situation where I have very little money to now being in a much better financial situation thanks to crypto. But I do want to share like different strategies to survive, to be able to build a solid foundation when you're actually getting ready for the next cycle, right? If you do believe that the bear market is coming soon or is already happening, then you want to make sure that you're financially handled to weather this drawdown. And this could be very different if you have a big portfolio compared to a small portfolio, right? A lot of people that might have like a few $1 million could easily survive a bear market. They could say things like, just keep buying, right? Like, don't care about the price, just keep buying, keep buying. And some of it is true, but there's some nuance to it if you are a smaller investor, right? Especially if you are relying on some investment income to pay for your expenses. You got to be a bit careful about what you do here. So what's a bear market? In my opinion, it's when Bitcoin and most major altcoins are trending down very aggressively. Every pump gets sold off. There's just a big lack of interest in crypto in general. And there's a lot of negative emotions like fear, disappointment, uncertainty. And it's just a very bad emotional experience for most people that are involved, right? But with people that are looking to invest long term, it's actually good that the prices are coming down because then we can actually buy these assets at a cheaper price. And this workshop I've already gone over with the Drippy Finance community about last week before the prices keep drifting down. But basically, we could go quite low when we're looking at the previous price action for the last few cycles, right? For example, in the last bear markets, Bitcoin went on more than an 80% drawdown, I believe, in like 2017, and then 70 something percent, almost 80% on the last cycle, right? And we could be sure that these altcoins, because they are less liquid and the chance of survival on some of these altcoins are not great, right? So a lot of these altcoins, if there's a widespread panic, could go down as much as like 90% or more, right? So if you are holding a bunch of altcoins and there's a pretty big drawdown, then your portfolio drawdown is going to be quite aggressive. So if you are exposed to too much altcoins, then it could be worth it to consolidate your holdings and make some adjustments, right? So we'll go over that in a second, but a bear market could last quite a while if you just pull up the chart, right? And measure stuff like, for example, the peak to reversal, it could actually last quite a bit. So if you measure like the peak of Bitcoin before the prices start to reversal, it's like 400 something days in the last cycle, right? So it could be quite an aggressive downtrend if you believe that this was the cycle peak, for example, and the bear market lasts approximately as long as the last one. It could actually pull us to like maybe the end of like 2026, right? So it could be quite a long drawdown depending on how the market actually reacts this time around, because every time it's going to be different, right? But you can see like in the previous price action, the drawdown could be quite aggressive before the price reverse. And then it could take even longer before the price actually break its previous high, right? It starts to reverse and then it takes, a year or two before the price even actually break the all-time high. So it could last quite a while. And then again, the past performance doesn't guarantee the future, right? You got to plan for at least 1 to 2 years of drawdown minimum. And it could always last longer, especially if we see a big financial crisis like in 2008 with the housing crisis. And then in the dot-com bubble, right, where asset prices bursted, then we could for sure see a deeper drawdown before we see a price break its new all-time high, right? So anything can happen. And sometimes even one of the best asset classes like stocks could just grind sideways for a few decades at a time. So we never know what's going to happen in the future. Past performance doesn't really guarantee the future. Previously, the CAGR, which is like the compound annual growth rate for Bitcoin, has been around like 50, 60%, right? Maybe in the future, it drops to 20%. We never really know. But in my opinion, if you are here, you're probably a longer term investor in crypto, right? You believe in crypto, you believe in the future adoption of DeFi. So the short term price action doesn't matter as much as long as you could survive the brutal drawdown. So how do we actually prepare for a bear market? We want to focus on these four things here that I will be sharing. The first one is mastering the basics. We're going to be protecting our portfolio, avoiding some of these mistakes, and then focus on some high value activities that we could do during the bear market. So the basics comes down to your personal finance. So it's not really about like how good you are at picking the winners when it comes to investing. It's actually about mastering the basics if you want to get through a pretty brutal drawdown because we got to have enough cash flow to survive, right? And the reality is most of our portfolios are not actually big enough for us to be living off of our income unless you have like multiple six figures at the very minimum and then like a seven figures portfolio and above if you have more expenses. So we got to get our personal finances in order. And this is especially important in a bear market. We want to make sure we're tracking our spending and our income. The most important part is the spending because a lot of our income could be easily estimated, right? But spending could actually get like out of control fairly quickly if you're like traveling all the time, eating out all the time and maybe spending on stuff that you don't actually need. Like maybe you're trying to upgrade a new car, but then the market has been quite weak and then your financial situation is not that great either. Then you might want to actually reconsider and track your spending, right? You want to make sure that you have at least a 6 to 12 months emergency fund and ideally even longer. For example, you could have like 12 to 24 months of emergency fund that could allow you to weather the bear market. And if you lose your job during the bear market, you're not actually forced to sell your assets at a very cheap price, right? If Ethereum, for example, drops down to like $1,000 to $2,000 and just move sideways for like a year or two, I don't want to be forced to sell Ethereum at a very cheap price to be able to live and pay my rent, right? I want to make sure that I could actually have extra income to buy these assets at a cheaper price. And we want to make sure that we spend less than we earn and then invest the rest of the money. And this sounds very simple, but most people actually don't do this. That's why most people live paycheck to paycheck or have consumer debt. It's because they spend much more than what they earn, right? So if you can't earn more money, then you gotta focus on dialing down your spending first. But once you dial down your spending, you want to actually focus on making more money, either from your job, freelancing, business, airdrop farming, trading, stuff like that. Of course, stuff like airdrop farming and trading is much riskier and your rewards are not guaranteed. And sometimes stuff like business is riskier as well, depending on what businesses you start, right? If you're starting a business that requires a lot of capital investment upfront, that could be a more risky thing to do, but it could potentially earn you more money. But in any case, this is not really a business channel, right? But the more you actually earn, the easier it is to become a pretty good investor because you actually now have the cash flow to invest. So don't quit your job unless you have a very large portfolio. So I have been able to earn a few six figures from crypto over the last 4 years here. And basically, I'm not quitting my job either that I'm doing. And I'm building Drippy Finance as well while I'm doing my investment management and consulting work, right? So my hours are pretty flexible. That's why I'm able to do these videos for you guys and hopefully provide value for you guys for free so that you could actually become better at investing and yield farming. So you want to make sure that you don't make the mistake of trying to quit your job too early when you still have a relatively small portfolio. And a small or large portfolio actually depends on your annual expense. So let's say you're spending like $50,000 per year, right? At the very minimum to actually live stress free is to have like a 4% annual return on your investment to be able to cover all of your living expense, right? At the very minimum. So if you have $50,000 of expense per year and the target of 4% real return, you want to divide that annual expense by the percentage rate, right? So in this case, you would want to build up your portfolio to be around 1.25 million. And of course, if you're still sitting in like six figures or lower, then it's going to take a bit of time for you to be able to actually accumulate this amount of wealth, right? And that's the reality of investing. If you're not making a ton of money, it's going to take you longer. So it's completely fine as long as your portfolio value is growing. And if we're still outpacing inflation and we're still generating return over time, then you'll actually get to your goals eventually, right? Assuming that you ran the numbers, you save more aggressively, and then you earn much more money over time. So we want to make sure that we dial down our spending and dial up our earnings as much as we can. So that's the very basic before you actually optimize your investing. You got to get your personal finance in order. And that's also why I, again, mostly recommend like a more passive yield farming strategy because you could be actually very active in the market, but then you actually could be making not that much returns on your investment, especially if the market is quite weak, like what you're seeing right now. And I've seen a ton of portfolios that put a ton of time to like manage and trade, and their performance is just not that good and is actually doing worse than what I've been doing, right? So just because you put more time into managing investment doesn't make your portfolio magically grow higher. So we got to make sure that we actually get our basics in order. And we want to make sure that we are protecting our portfolio, especially if you guys can't afford to lose everything. We want to make sure that we have cross asset diversification, right? And I was writing this post on X yesterday on how you could grow from like 0 to 10K, 10K to 100K, 100K to 1 million, and then 1 million and above. And I've basically been able to grow my own personal portfolio from 0 to around a few six figures here. And I've also worked with like clients who have like multiple eight figures that I help manage, right? So I know exactly how most people got their wealth. And then I've basically created a plan that is more suitable for me, but also I believe a lot of people could benefit from, right? Let's say you're in this 0 to 10K range. You actually don't want to spend that much time like managing investment simply because you're not going to get that much mileage out of your small portfolio, right? Let's just say you have like $1,000. It doesn't even matter if you make a 300% return. You're still not going to make like even $10,000 in a year, right? So at this stage, we really want to focus on our active income, like your job, freelancing, business, and or airdrop farming, and some other opportunities that could give you more leverage on your capital, like active investing. But in my opinion, active investing is quite difficult, especially when the market is quite weak, or even trading, especially if you can't afford to lose that money. So I personally would not be focusing on that. Then once we are actually able to make that income, we could start providing liquidity to earn some passive income and actually compound our growth over time, right? Different pairs like Ethereum to USDC, if you believe DeFi is going to be around for quite a while, then it's a very good pair to start actually accumulating your assets in, right? And then if you're breaking through the 10K to 100K, then we want to do pretty much the same thing as above, but then we want to start thinking about accumulating different assets like stocks, gold, and potentially different REITs, right? That have exposure to other markets. So then we're not actually fully exposed to crypto. If you suffer like a scam or a big hack, like what I had in September, you're not completely wiped out, right? I lost like 76K, which is quite a big amount for, anybody, right? It's about like 1 year worth of like a US salary. So it's a painful loss. So that's why I do recommend, like, even if you could make like much more returns from DeFi, you still want to think about diversifying earlier on, right? You want to build that habit. You don't want to be like fooled into thinking that there's no risk in DeFi, and then you just keep compounding your gains. And then when you hit like, let's say like 500K, and then maybe you suffered a pretty bad loss, and then you at that point, regret not diversifying, right? So I've seen a ton of people that ran up their portfolio to a few hundred K or even a few $1 million, only to lose it all because they never took the time to start diversifying earlier on. So this is the zone where I'm currently at. Some people call it the six figures hell. I don't think it's like a hell or anything, because I think like if you've already made it to six figures, your road to like a million is going to be smoother than, if you're starting from like only a few grand, right? So if you're at six figures, you gotta be more patient. You gotta basically keep doing what got you there in the first place. And you want to make sure that you don't take too much risk, right? It could be very tempting to, like, let's say you're at like 500K, right? It's very tempting to like try to find an investment that could 2x, so that you could move very quickly from 500K to $1 million. But you got to realize that if you lose a ton of money with a larger portfolio, it's going to take you much longer for you to recover your funds. The reason why it's so difficult, if you've actually built your wealth from like investing and stuff like that, is because oftentimes if you have a smaller portfolio, it's easier to take more risks because the amount is not that much relative to your income, right? So let's say you're making like $50,000 per year, and maybe you saved up to like 10K to risk on like more speculative investment. Maybe you pull like a 5 to 10x on your capital. That is a much different risk profile than like, risking 200, 300K on like those same type of strategies when you only still make like 50K from your job, for example, right? Because it's going to take you much more time to recover 2 to 300K if you lose that money. So risk management is very crucial here. And then if you have above $1 million already, you want to make sure that, again, you have enough cross asset class diversification, just because a brutal drawdown could come out of nowhere in like a specific market. Having cross asset diversification can actually protect you from a lot of those drawdowns, right? Sometimes, like, for example, stocks drop by 30%, but gold is maybe not even budget or actually moving up in price. And it works the same way with crypto. And then at this point, you probably want to have like more stable coins as well, or like more cash to make sure you absorb the volatility of your crypto portfolio, right? And then if the volatility goes to the downside, you could take advantage of those buying opportunities. And at that point, if your investment is outpacing your expenses, you could actually take more swings in investing. So people make the mistake thinking that like when you have very little money, that's when you could actually take a bunch of risks. And that is a bit true in a sense of what I just covered, right? Like if you make 50K and you risk 10K per year in like riskier stuff, of course, that could be a strategy. But if you're in that like 200K zone and then you're using that capital to risk everything on like a risky investment, you could lose a lot of wealth pretty quickly. But the advantage of big portfolios have is that they could generate a bunch of cash flow, right? Let's say like 1 million is earning like 10% APR, which is very conservative in DeFi per year. That's like 100K worth of capital that you could put into more speculative investments or into a new business if you want to, right? So the more money you have, actually, the more swings you could take. Of course, it might not move your portfolio percentage by much, but in like the total value is actually quite a lot, right? Let's say you take like 100K per year to put into like more speculative investments like altcoins or to farm airdrops and stuff like that, even if you lost all of that money, your 900K of portfolio could actually recover that amount fairly quickly. But if you made like, let's say a 5x on that 100K, that's still like 500K worth of total money that you would have from that speculative investment, right? So the more money you have, you could actually take the swings much more aggressively versus actually having to rely on your investment income or your job to actually make things work, right? We want to make sure that we deleverage if we want to take some risk off the table. And a lot of people teach, like, let's say prices are rising, you keep dialing up your leverage to maintain a total like LTV ratio, right? Let's say your target LTV ratio is like 35 to 45%. You're maybe using like a bull lever strategy or like a treasury company type of deal, right? Where you're like depositing different assets on different platforms like Aave. You're depositing Coinbase, Bitcoin, Wrap Bitcoin, Ethereum. You're taking the loan out of like your assets, 30 to 45%, right? But if the prices move up, you're actually increasing leverage as you go, then you could actually be blindsided by the dump and then you could lose a bunch of money in the process. Because if you keep dialing up your risk while the prices go up and the prices pull back, which it almost always does, then you could be very easily liquidated and lose a bunch of money. Ideally, you want to deleverage into strength. If you're looking at Ethereum, for example, if it's like near its previous all-time high and you're still like fully levered up, that's probably not like a very smart thing to do, right? Of course, you don't have to like repay everything if you believe that a breakout is coming. But then if we had a failed breakout and you're like fully levered at the top, then you could be in a lot of stress right now, right? I've seen a bunch of people that come to me after like following these strategies that are not really well thought out. And basically, I'm here to actually help them and fix the mistakes that got them into that bad place in the first place. So it's very important that you deleverage. And then if you do expect the bear market coming, it's ideal that you don't actually have any leverage that is exposed or only having like a portion of your portfolio that is exposed to leverage. So I never personally expose my entire portfolio to leverage. I don't think that's a great strategy simply because if you get like liquidated, then you can lose a bunch of your portfolio, right? And we never know when a big dump is going to come and how deep the liquidity actually is. I've seen a ton of people that over levered on like different altcoins, maybe some like smaller layer ones that for sure got liquidated in like that October 10th liquidation event, right? So we want to make sure that we deleverage, especially in a strong market. And then we want to have enough cash to not have to sell our investments at a discount. So this is why like most people that don't have enough cash are not actually able to buy these assets at a discount, right? If we look at the stock market, sometimes the drawdown could be quite aggressive. If we go to like the 2008 drawdown, for example, right? A lot of people like lost their jobs or lost their homes, and then they're not actually able to take advantage of that 50% discount, right? So if you were like over leveraged and then you also lost your job and then, you have like family to feed, you have rent to make, then it becomes a very tricky situation on actually like accumulating your assets at the very low point. So we want to make sure we have enough cash. That's why I recommend the emergency fund. We want to keep stacking stables and Bitcoin with the fees that we earn with our yield farming, right? I've been saying on my channel for multiple months now that especially when the prices are strong, we want to be de-risking and selling our fees into stables and Bitcoin. And if you're already very heavily exposed to altcoins, we want to balance out our risk by buying more Bitcoin or if you want more market exposure or fully selling into stables if you don't want to have that much market exposure, right? And if you're still holding on to some like altcoins that are weaker fundamentally, and like if you're looking at the price action, it looks very weak and the narrative is very weak, or if the team is basically not doing much, then it could be worth it to consolidate your holdings into a few holdings that have really good fundamentals and good teams behind it, right? Some projects like Pendle, in my opinion, has a pretty good team and pretty good fundamental, and they have a moat behind their business. The price action is quite weak because the altcoin market in general has been weak. But in my opinion, a project like Pendle is going to be more likely to survive than like maybe are not getting that much adoption, right? An example might be like the Optimism token, right? The OP token. You can see the price action has just been pretty brutal over the last. You can see its high was at like $4.6 and now it's at only $0.39. So if you're still holding on to those tokens, then it could be worth it to like consolidate your holdings. And ideally, you want to do that before like a chart like this happens. So we want to make sure that we actually reanalyze our holdings and hold on to the ones that are likely to survive and still have a good upside if you still want exposure in the market. And we want to make sure that we double down on our wallet security. It's very important to learn about wallet security, use a hardware wallet. And I can probably make a video on this later on. But basically, every transactions that you do on chain should be coming from your hardware wallet that is connected to like a browser wallet like Ravi, Phantom, or MetaMask, right? But you could have like a testing wallet like I currently do on this computer where I just use it to connect to some sites to look at like the data because sometimes some dApps do require you to connect to like their site to be able to access some data, right? And I also use a small amount on that wallet to test out different dApps, but most of your funds should be in a hardware wallet. And these are the major mistakes to avoid, in my opinion. The first is trying to live off of DeFi with a small portfolio. So if you've been around the block for a while now, you know that a bunch of people would advertise like the APR of like, let's say concentrated liquidity pools or like different DeFi protocols, but they don't actually talk about like the actual profit and loss, right? The reason why is sometimes like with higher APR strategies, you're going to be suffering more of a capital loss if the market is weak, like what we are seeing right now. So it's a pretty difficult situation if you're trying to live off of a small portfolio, because with higher yields, you're often taking more risk versus let's say you're farming ETH to USDC or maybe like Coinbase Bitcoin to USDC, ETH to wrap Bitcoin. Those pairs typically have lower yield and they are much more sustainable than a lot of those other smaller cap altcoins, right? For those smaller cap altcoins, I do still invest in them, but I do invest in a way that I realize, okay, these yields are not going to be pretty if the prices drop pretty aggressively. And we got to basically operate from that mindset and not have to actually live off of our small portfolio if we don't actually have enough assets to sustain ourselves, right? The second is we're not preparing for a bear market in good times. So this is not the first time where like I have mentioned, it's a good idea to start de-risking, sell some of your fees. If your positions are in profit, take some profits off the table. It's always good to take profits because we never know when a brutal drawdown is going to come and when the prices are just going to be weak in general. In 2025 so far, mostly Bitcoin has been doing okay. It's kind of just moving sideways, but most altcoins are just not having a good time during this 1 year or so, right? So we want to make sure that if prices move lower, we could actually survive. And then we also want to avoid flip-flopping. So flip-flopping is when like you decide to like, let's say stay long on altcoins. And then next week you're deciding, okay, maybe the risk is too much. I'm selling my altcoins and then I'm getting out of it. And then the week after that, you decide like, okay, maybe the market is going to recover. Let me buy back into the market, right? That's how like a lot of traders and investors get chopped up. The reason why is because if you're flip-flopping, you could be buying and selling at a pretty bad time, right? Let's say you buy Ethereum at $2,500 and then the price goes to $3,000. You decided to sell all of your Ethereum. That's still fine, right? You took some profit off the table, but then the price went up to like, let's say $4,000 and you believe the breakout is coming. Then you're buying back into Ethereum again. Then the price dropped to 2,500. Then you could actually suffer a loss in that scenario, right? Even though the price basically just comes back to like where your initial entry was. So this is what I see all the time in like more active investors. Sometimes they're like trying to position long and then they're positioning short like a week after, or like they're doing delta neutral stuff one day. And then maybe the next month they're going like super long on leverage. And then basically they're all over the place when it comes to like positioning themselves in the market, right? In my opinion, for longer term investing, you always want to position yourself more long than like short, just because you want to actually have market exposure. And I personally want to avoid doubling down on altcoins that have little chance of making it. And it could be a bunch of different altcoins, right? Like you want to analyze the fundamentals, the team behind it, and stuff like that. You want to make sure you're not actually having too much exposure in altcoins, especially if you don't have other asset classes like stocks. We don't want to keep doubling down on altcoins that could basically keep bleeding out, right? If we're looking at something like Polkadot, which was quite popular last cycle, you're going to see that the price has basically just bled out over longer time periods, right? So if the price dropped in the last bear market and then you were trying to buy the dip, maybe you bought the dip here and then you kept buying the dip all the time, then, the price could just keeps going down forever, right? Not every chart is going to look like Ethereum or Bitcoin or Solana. So that's something that we got to keep in mind. Not every alt is going to make it. So we want to keep investing into the market long term, but we don't want to keep doubling down on assets that might not make it. And then we want to avoid selling all of our assets into stablecoins. So if you want to sell most of your holdings, in my opinion, you still want to have some exposure to Bitcoin and maybe some Ethereum, but we don't want to be selling everything to stablecoins. The reason why is we don't know the future and you could be easily sidelined. For example, you could be right about like the retrace. Let's say you sold like some Bitcoin at 100K back in January. You could be right about the retrace coming, but maybe you could be wrong about where the price would bottom out. Let's say you sold at 100K, but you believe the price is going to drop to around like 67K, right? But maybe the price just kind of dropped less than what you expected. Then the price rocketed up. You never actually got your entry back into the market, right? And of course, if the price dropped below, and let's say the price goes to this 50K mark, you would get another entry there. But most people would not actually be patient enough to wait for that better entry. And we never know if that entry is going to come, right? Bitcoin, for all we know, could just be grinding around for quite a while and then keep moving upwards, right? We don't know what's going to happen in the market. If you actually believe that, then you shouldn't be selling all of your assets into stablecoins, especially if you are a longer term investor into the space. We want to have long exposure in the market. And that's why I still hold onto a lot of my crypto. I've de-risked a bunch of my crypto over the last 4 years, consistently take profits out of the market. But if you haven't done that and you're just getting started, you should actually be a net accumulator of the assets rather than like trying to take the swing up and down all the time, right? And I think it's a mistake to check out during the bear market. The bear market and when the prices are weak, when everything feels boring, that's when like you should be locking in because that's where most people leave. And then there's most opportunities to do stuff like airdrop farming, to post content, or to actually invest into like good projects, right? If you are investing only when the hype is there, then typically prices are trading at a much higher valuation than when there's like a slow period. So we want to make sure that we're locking in rather than checking out during the bear market. And then I've made this mistake myself in the last bear market. It's just not buying anything during the bear. I did pretty well in the last bear market in that I was like doing stuff like flipping NFTs and then also farming airdrops, got a pretty decent income from that. But I should have been buying different assets like Bitcoin for cheap during the last bear market, right? I simply was just not that focused on like that side of things. I was doing a bunch of different stuff and just wasn't really thinking about like actually accumulating Bitcoin. So this time around, if the prices do drop pretty aggressively, I would be buying much more aggressively. And then I'm also dollar cost averaging, whether the price goes up or down, it doesn't matter to me. I'm going to be buying at least like $500 worth of Bitcoin every single month. And ideally from like the yield farming income that I get, or like the different airdrops that I could be getting, right? So what should we actually do during a bear market? The first thing is the asset accumulation that I just talked about. We could be providing liquidity for different crypto to crypto pairs. If you are basically trying to accumulate more altcoins, and then you could apply the altcoin swing strategy that I do share pretty often on my channel, right? We try to get in at a good entry between stuff like Pendle and ETH. And then we try to wait for a swing back up where altcoins are outperforming ETH. And then we could exit our position for a nice ETH profit, right? Of course, it doesn't always happen like what we're seeing right now. I entered at this green line, and then the prices are kind of sitting just right off of my range here. My range is at about like 0.0008. And right now it's at like 0.00077. So I'm out of range a little bit, but that's not a big deal if I expect the prices to swing back up eventually, which I do. So I'm not gonna like worry about that too much. But that's something that you guys could always do in a bear market, right? There's a lot of pairs to look out for. And if an asset is undervalued, you could always swap some of your Ethereum into like an altcoin pair to try to yield farm, get some yield, and also gain more Ethereum in the process. But again, you are taking more risk when you are actually yield farming these assets. So we want to make sure that we actually don't get overexposed into altcoins, right? And then if you have an active income source, that's the best way to grow your portfolio, like working a job, freelancing, your business. And that's currently what I'm doing as well, right? I have my normal consulting work and I'm also building Drippy Finance. So that's a source of active income that I could inject anytime into my DeFi portfolio. You could work on stuff like content creation, airdrop farming, active investing, and content is more like a long-term game, especially for me. I do want to build inside the space. That's why I am creating these content. And hopefully it's a win-win, right? These content help you out and then eventually would set me up for higher income in the future as well. But the main idea here, if you want to be in crypto long-term, you want to be fairly active, you want to put in the time to learn and interact with crypto, if you want an edge in the market. The reason why I know a lot about yield farming is I don't really care when the prices are cheap. I'm actually doubling down and studying a lot about DeFi and yield farming, right? Most people, when the prices are cheap, activity is low, everything feels boring. They just leave the market and just don't actually spend the time in, right? And then eventually people that actually put the time in would outperform these people that are just here during the good times. So those are the stuff that you guys can focus on during the bear market. And if you're watching this, you're probably wondering, are we actually going into a bear market? Again, this video is not calling for a deep bear market. In my opinion, no one actually knows because it takes like one big seller or a big buyer to actually collapse or pump the market, right? Like if MicroStrategy, for example, starts selling their Bitcoin, I don't think they will. But if they did, they could actually tank the Bitcoin price by quite a bit, right? So we don't know, even based on like technicals, fundamentals, what truly is going to happen in the market. For example, a ton of people were expecting a lot of liquidity from Bitcoin is going to flow into altcoins, but there's like data saying that maybe that's not happening, but maybe it could happen in the future. We never really know. And altcoins have been weaker this cycle and even weaker this year. So we never know what's going to happen, but hopefully things do turn around in the next 6 to 12 months. If there's more like speculative capital, or maybe if some of these major assets like Solana or Hyperliquid starts like moving to the upside, maybe breaking out, I believe that a lot of these altcoins would pump as well. And especially Ethereum, I believe if Ethereum goes up really high, that could be a catalyst that could bring on an altcoin run, right? But in my opinion, it's better to be prepared and have a plan in place rather than hoping for the best. That's why I made this video for you guys. And hopefully this video has been pretty helpful so far. And again, I did run like a full workshop and Q&A in the Drippy Finance Discord. If you do want to join our community and grab the course, you could check out the link down below. The course is pretty comprehensive when it comes to stuff like yield farming, how to manage risk, how to build your portfolio, and some of the more important concepts that you really need to be aware of when you're investing into crypto. So, but if not, just check out those other videos on my channel. I try to give you guys as much value as I can. Thank you once again for watching. I'll catch you guys next time.